Greetings, wonderful traders. I welcome you to this video, and in this video I'm going to be sharing with you simple tips and secrets on how to trade Volatility 75 index the right way. So before you can watch this video, remember to subscribe. If you are not a subscribed member, remember to like the video and share it with your friends. So what I'm going to be sharing with you, it is just simple tips. It is not just strategies, but it is tips and approach that you need to give the market for you to improve your trading. So the first thing that you need to understand as a trader, it is firstly the nature of this asset. You must understand the nature of this asset. When I'm talking about the nature, I'm talking about the fact that this is not a currency, or this is not an economic asset. So if it is not an economic asset, you need to understand that the way it behaves, it is not going to be affected by economic news. It is not going to be affected by economic event or any other economic factors, because this is a synthetic ETF. So one thing that you need to know as a trader is that we have indices like Nasdaq, indices like German DAX 30. Those are real indices, and then we have the synthetic indices. So when it comes to synthetic indices, that's where we are referring to these guys here, the volatility indices. So when it comes to volatility indices, you need to know that they were created by brokers, or you can also create your own synthetic ETF that is going to imitate the market in real time. So this asset, it is trying to imitate the real market. It is not the real market, so there is no psychology involved here. That's why when it comes to trading V75, you are free as a trader to apply any particular system, but when it comes to trading currencies, you are only bound to psychology based approaches. For an example, the reason price action or price patterns are working in currencies or stocks, it is the fact that they are from the mind of human beings, or the mind of the players, which are buyers and sellers. So it is psychology based. That's why it works. But when it comes to this side of volatility indices, that's when now you have the freedom to approach the market even in a way that doesn't involve psychology. That's why you can apply indicators and they can work. You can apply a strategy that is only based on indicators, and that strategy is going to work. Why? Because here there is no psychology. There is no psychology that is involved. So it is just a synthetic asset. So that's the first thing. Understand the nature. Make sure that you are not bound on psychology based strategies when it comes to this market. If you are a person who have a strategy that is not psychologically based, you can apply it here and it can work well. What will help you, it is actually not bringing a mindset of currencies here. Just give this market a new approach, and it is going to shock you with a good result. Just give it a new approach. Try to find a simple way to go about this market so that it can work for you. Just change a bit of your strategies. Yes, you can apply the strategies used on currencies, but just try to change it a bit. So now the next important thing that I want to give to you, it is to understand one thing, that it's all about momentum. It's all about power. Remember the point that I just gave you, that this is not psychology based. Although it is not psychology based, there is one thing that they really did with these assets that is very, very wonderful: the ability to trend for a long period of time. That's the good thing about this asset, that if it is moving up, it is going to move up for a long period of time, and if it starts going down, it is going to go down for a long period of time. Meaning, when it comes to the momentum, it is a continuous momentum when it comes to this asset. So that's a thing that we should hold on to as traders. Let us make sure that our eyes are focused on momentum. Let us make sure that we pay huge attention to this wonderful gift that they placed in these assets. These assets, they move in one direction for a long period of time. So when you find it moving in an uptrend, just make sure that you join that particular uptrend and you buy right there in a good opportunity. When you find it flowing down, make sure that you look for those selling opportunity in that particular market and you are ready to go. So here is another important tip, the last one. So make sure that when you approach this market, your approach is very clear. Sorry, your approach should be very clear. For an example, you can either approach it the genuine way, or you can also approach it the aggressive way, which is linked with sort of gambling. But I'm going to give you the guidelines on how to really profit from that, not actually being a gambler, but it is an approach like that. So when you approach it the genuine way, that's whereby you have a fixed risk reward, you have a fixed percentage that you are risking of your account, and you apply those small lot sizes, and you are not looking forward to any quick riches. That's the genuine way, the way we trade when it comes to all the other assets, stocks or currencies or other indices or commodities. So that's the genuine way. So when it comes to this aggressive way, I once spoke about this, but I'm just going to repeat it because I don't think a lot of people got it. So what you need to know, what you need to understand, it is to make sure that if you are really hungry, or if you want to squeeze everything out of this market, make sure that when you trade with your account, you fund your account with that particular amount that you want to risk. For an example, let's say you find your account with $50, and when you find your account with that $50, that's the amount that you are going to risk in total in that particular day. For an example, let's say you've put this $15, then you are going to open maybe, let's say, 2 positions of this asset, or just 1 position, and kind of take up the lot size. When you lose this trade, you need to know that you lose the entire amount. But when you make it in this trade, you need to know that you'll make a lot of profits, like up to $150, depending on how patient you are. So this is what I used to do earlier as a synthetic index trader. This is what I used to do, actually, to just put that small amount which I'm going to risk. For an example, this percentage, which is $15 of my my money, and I'm going to put it there, and I'm going to risk everything. And when I make it a lot. Look at this, it is actually times 10. Meaning your risk reward, it is 1:10. It is 1:10, meaning in every $1 that I risk, I make $10, and every 15 I make 150. So which is a massive risk reward. So now here is the trick to go about it. You should make sure that you don't trade anyhow and at any time. Make sure you have that well-defined system, and make sure that when you take this trade, you take this trade at the rightest time as possible. That's why you are going to be ahead, because you'll be taking your trade at a very great point, or at a very great level, based on your system, based on your strategy. So just make sure that you comment below if this was helpful. So that's it in this wonderful video. Thank you for watching. Remember to subscribe, like, and share. Thank you.